Thank you. And I welcome now Mr. Roger Heacock. He is the president and CEO of the Black Hill Federal Credit Union in Rapid City, South Dakota. The Black Hill Federal Credit Union has over 49,000 members with assets of more than $765 million. Mr. Heacock is here to testify on behalf of the Credit Union National Association, the national trade association serving America's credit unions. Welcome.
Chairwoman Velasquez, Ranking Member Graves, and members of the committee, thank you so much for the opportunity to testify on behalf of the Credit Union National Association. I am honored to address the impact SBA lending has on our local economy, our credit union, and our members, and to suggest ways to improve SBA programs. Black Hills was first authorized to do SBA lending in January 2003, and we truly value our partnership with the SBA. We wrote more SBA loans than any other financial institution in South Dakota during 2008, 29 loans for a total of $1.6 million. We are looking forward to working with new SBA Administrator Karen Mills and find working with the SBA beneficial to the credit union and our members for several reasons. We have a number of members who started small businesses using SBA loan funds while continuing to work at their primary job as their main source of income. The SBA helped us be there for our members, and this has resulted in additional employment opportunities. There is additional risk to these types of borrowers, and quite frankly, other lenders shy away from helping them because there is not a proven cash flow. We are able to do this type of lending because of the guarantee that SBA provides. The programs allow us to help the borrower who comes in and may not have the equity investment we would generally like to see, but has a good business plan. The SBA helps us create an acceptable level of risk, and it is a win-win situation for all of us, the credit union, the SBA, and the borrower. CUNA is a strong supporter of the 7A and 504 loan programs, essential tools for achieving our mission to serve the needs of members. However, several important factors discourage more credit unions from participating as SBA lenders. First, the statutory cap on credit union MBLs restricts the ability of credit unions from helping their members even more. Even though the cap does not apply to SBA loans, it is a real barrier keeping some credit unions from establishing an MBL program at all. Not all loans fit SBA parameters, and credit unions are reluctant to initiate an MBL program when they may reach the cap in a fairly short order. CUNA is also aware that some lenders have not had a positive experience with the SBA, citing the application process, fees, and time of decision making. In that vein, we think there are ways to improve the work that is done by the SBA. As the committee reviews SBA programs, we encourage Congress to make additional funds available to the agency so that fees can remain low and the guarantees can remain sufficient. We appreciate Congress setting aside $375 million for the temporary elimination of fees and raising the guarantee percentage on some loans to 90% as part of the Recovery Act. In closing, credit union business lending represents just over 1% of the depository institution business lending market. Credit unions have about $33 billion in outstanding business loans, compared to $3.1 trillion for banking institutions. We are not financing skyscrapers or sports arenas. We are making loans to members who own and operate small businesses. Despite the financial crisis, the chief obstacle for credit union business lending is not the availability of capital. Credit unions are, in general, well capitalized. Rather, the chief obstacle is the statutory limits imposed by Congress in 1998. Under current law, credit unions are restricted from member business lending in excess of 12.25% of their total assets. This arbitrary cap has no basis in either actual credit union business lending or safety and soundness considerations. And the U.S. Treasury Department found that delinquencies and charge-offs for credit union business loans were much lower than that for either banks or thrifts. The cap effectively limits entry into the business lending arena on the part of small and medium-sized credit unions, the vast majority of all credit unions, because the costs and requirements, including the need to hire and retain staff, with business lending experience exceed resources of many credit unions. While we support strong regulatory oversight of member business lending, there is no safety and soundness rationale for the cap. There is, however, a significant economic reason to eliminate the cap. America's small business needs access to capital. We estimate that if the cap on credit union business lending were removed, credit unions could safely and soundly provide as much as $10 billion for new loans for small businesses within the first year. This is economic stimulus that would not cost the taxpayers a dime or increase the size of government. Madam Chairwoman, thank you very much for convening this hearing and inviting me to testify. I look forward to answering the committee's questions.